Ladies and gentlemen, welcome to this special interview. Today we have a returning guest to the show, Chris Vermeulen of The Technical Traders, located at thetechnicaltraders.com. And I got to tell you, we get a lot of technical analysis coming through Silver Doctors, but not many people have been spot on like Chris has been on his calls lately. And Chris is not just a professional trader, but he's also a market strategist. So hop on over to The Technical Traders and see what they have to offer. Chris, I'd like to thank you for returning again to Silver Doctors.
Hey, thanks for having me, Paul. Awesome to be here.
Now, Chris, I'm looking at silver, and here are my thoughts with silver because I'm a fundamentalist at the heart. And I've got a million reasons why I can give you the bullish case for silver based on the fundamentals. But I'm looking at silver's daily chart, and, we had that near-term head and shoulders set up there to deal with for a while, but it got invalidated. And then silver started getting on a run, and all the technical analysts were like, oh my goodness, bottom's about to fall out. It's way overbought. It's too extreme on the technicals. And you're like, nah, silver's getting ready to move higher. And sure enough, we're breaking out big time this week. Chris, What are you seeing in the silver market, and what are the charts telling you?
Yeah, there's a lot going on, but the bottom line is gold has technically broken into a bull market. And we saw gold do it last year, large caps early this year, and then the small caps really just a few weeks ago. And now we got silver joining the party. Silver's always a little late, it seems, coming to the party, but it always plays catch up. And here it is. Just look at the price action this week. Just incredible prices. With big breakout above. To me, the breakout was about $21 an ounce. And as soon as we broke that, really, we just saw, I think, big short covering, people piling in, chasing prices up. And now, here we are. The next target for me is about 24.36 is the upside target. And that's based on Fibonacci analysis, the momentum in the market. So there's a little bit more room to the upside. Everyone's really bullish, and I'm bullish on it, but we might see some weakness coming forward for potentially several months, which is not a bad thing, especially after a move this big and this quick. It's we need to see a break, but it's really exciting to see silver break out because we've been waiting years, and now we're like at 6-year highs, which is pretty significant.
Mm-hmm. It is, and it is exciting because I'm looking at the price last Friday and we're up over 20% just this week. So the breakout has indeed been real. Now, Chris, you've been talking about measured moves, and it seems like we're in this kind of measured move with silver because we literally just plateaued up. So could you explain, what do you mean by measured moves, and what does it mean with silver?
Sure. Yeah, silver's made a lot of measured moves, really. Over the last 10 years or so. If we go back to the last bull market of silver, the way it rallied up and the way that it actually declined from the 2011 2012 highs, each time it's been stepping its way up, and then it steps its way down in these measured moves. And what they are is, I use Fibonacci extensions, which is a simple tool most charting platforms have. Fibonacci is a ratio, percentages of moves that nature seems to form, and everything it creates, and including weather and you name it. And so you can apply that to the stock market, and really it's almost like herd mentality. It's waves that people think and feel, and visually they're balanced. When you do Fibonacci extensions on the charts, you can find out where the previous low was, where the next high is, and that pullback. And once you've got those 3 points, you can apply Fibonacci extension, and it'll extend, saying, okay, well, there was this much power on the rally, this much on a pullback. That means we should see this target hit or 100% measured move hit. Usually I go for the 618 and then 100% of the mirrored move. And so silver's been doing that for years, and now we're on our way up to this 24.36 on silver, and that is a Fibonacci measured move from the lows we saw from March. So this is a really significant resistance zone. It's a huge pattern, and that price coincides with a price high on the monthly chart, several price highs back about 6 years ago. So there's a lot coming into play where that Fibonacci target is. And it's funny because when you use Fibonacci, even on shorter term time frames, those targets tend to be also previous highs or previous lows from on the chart. It's amazing how the markets will move. You'd have no idea that if you were to draw a line from that target across, it's a really significant pivot low and pivot high in history. And so when you have more of those line up, which is what 24.36 is, it could be a pretty significant resistance zone, and we're probably going to get a pause or pullback there.
Mm-hmm. Very interesting. And some observations that I'd like to add on to that is when it comes to the pause and the pullback with such momentum, is it also possible that the pause and the pullback could be shallow as well? Because, people have been saying, yes, the technicals are extreme. I'm looking at the RSI, and yes, I get that it's extreme. But, these are fast moving markets. And, I'm just thinking that what we've seen so far, is it possible that, it might not be as shallow, or it could be not as long of a consolidation or a correction as people are thinking? Am I thinking about that or making sense in any way there, Chris?
Yeah, I totally get what you're saying. So two key points. Everyone interprets indicators differently. So you're talking about RSI being overbought. And the way I see RSI is more or less, I look at RSI like it's muscle. And so when you're above that 70 or 80 point and you're in that, what most people think is overbought territory, that's actually the power zone. That's where you get that's where the trend, you want it up there. It's more likely to stay up there and continue and see price go than it is actually to reverse. So I look at RSI when it's in the overbought or oversold. I consider that muscle. That means the trend's got lots of strength. It's the leader. You want to be in those. When they do reverse, though, you want to make sure you can get out, because they should drop pretty quick. So that's the way I see RSI. Now, in terms of price pullbacks, we're not going to know until we really start to see the first day or three of what kind of momentum is behind a pullback. But if you go back in time with silver and you look at the size of move we've had now, typically we get an 8 or 16% correction from here. Mm-hmm. So I think if we were to go up, and maybe the top's in, maybe we're going to pull back 8 or 16%, that would bring us back down to kind of the breakout zone. And it would be the first pause or pullback. And the key with bull markets is, once something's in a bull market, you can buy the first pause or pullback. That is like kind of the lowest risk opportunity to get in as a long-term investor, because it's a bull market, should last years. There's a couple caveats there. While it might be moving into a bull market, when you look at the shorter term price action, we could talk about this if we want to and go in more detail, but more or less, we have actually very similar price action to what we saw in 2007 and 2008, where when the stock market is starting to top out, it's losing momentum, it's making new highs with fewer and fewer stocks supporting it. The economics are slowly eroding. We can see kind of a dark, dreary future for economics. This is when gold miners shine. And this is what they did along with silver and gold in 2007, 2000, and very early 2008. We saw this huge pop in gold, silver, and miners. Only lasted 2 or 3 months. And then the bear market started, and then the miners and metals pulled back with it. And that's what I kind of feel like is going to happen again. That being said, they've all broken into a bull market, so I don't really see them crashing and collapsing and falling back into a bear market. I think what they're going to do is they're going to trade lower. They're all going to be testing major support levels lower down on the chart. But what it's going to do is going to set up a very similar pattern to 2009, 2010, where it's actually building a bigger base now for it to take off near the end of a bear market in equities. So I think we're going to see higher prices here for potentially another week or 3 or 4. And then I think they could get pulled down a bit and be out of favor for several months. These patterns are multi-month patterns, right? Usually each pattern is about 8 months to 16 months long. So this is a big play. This is the start of something huge. But I have a feeling some of the biggest gains aren't actually going to happen for probably 8 or 16 months, where we see silver really explode out of this base. It'll be more or less, an 8 or 9 year base. So it's really exciting. The price action that's unfolding, even if we get a pullback and pause for several months, makes it more bullish long term to go a lot higher.
Mm-hmm. It is exciting price action, especially this week. And another thing about silver, which once gets me to want to transition into gold, is, we're still a country mile away from all-time record highs in silver, sitting here in the mid-20s. But look at gold, and gold's almost threatening to poke its head through 1900 just today, Chris.
I know.
So it's pretty exciting. What are you looking at in gold? What are the charts telling you? And what are your thoughts in general there?
Yeah, gold to me has got the lowest amount of risk because it's not quite as speculative. People around the world naturally flock to gold. If they're kind of worried about things, they don't really think silver. The majority of investors, people, who aren't totally in tune with the market, they think stocks, bonds, and they think gold is still a stretch. Silver is not even in their idea, their
Yeah.
bubble, right? So gold is, and that's why gold is broken out. People around the world are fearful. They keep trickling into gold. And I think no matter kind of what happens going forward, we're going to continue to see an inflow of gold as that kind of comfort zone for the masses. And that's why it's been doing so well. I think it's got the least amount of downside. And as it gets up in value, the higher it goes in value, I also think the more likely it is that there could be some type of gold-backed currency that could come out to some extent with it, because obviously the higher the value it goes, the easier it is to make it a currency. I think simply from a storage standpoint, you need much less weight to have as much value and deal with the storage and stuff. So I like gold a lot. It's the big kind of bubbly safe haven. And then you drop down to miners, and then you drop down to silver. So I really like it. We're on this verge of breaking. I've got about a 1967 target on gold over the next maybe couple of weeks here, up to the 2000 range. That to me is going to be really significant. It actually kind of feels a little bit like a 2011 kind of, everybody's piling in. It's kind of a final little short squeeze. And then I think we're going to see the markets change and catch a lot of people off guard. And that'll be great because gold will have made a new high. It'll be kind of flagging out for potentially a year or so, it would be a huge cup and handle pattern. And that would give us about a $2,600 target that once it starts to break out of there, it's going to just take off. So I really like gold a lot because it has a lot less risk. Not as much upside, but it doesn't have as much risk. I think it'll hold up the best during tough times in the stock market.
Mm-hmm. Very interesting. And speaking of tough times, yes, you are a technical trader, but you just have a good grasp on the macro side of things, because I think you explained it really well with what happened in March there with the precious metals, which got us to where we are today. So could you just explain some of like these fears that you're talking about how it's putting a bid into gold and silver right now? For example, you were writing that in March what had happened is just all of those trades had to wash out in that washout low that we had, or I'm probably not quoting you exactly right there. So I'd rather have you explain it, Chris.
Yeah, so there's a lot at play really when we had the March crash. I mean, everyone always, just like when you go to buy a home, you always want the home that's a little out of your reach, and you buy the one that's too expensive. You always over leverage. Everybody wants more of a good thing, right? And that's the problem with traders and investors, is they always want more of what they own. And so everyone becomes over leveraged. And we've just had this massive rally in most asset classes that led up to February, where people are just really overexposed and highly leveraged. And so once the market starts to sell off, they see their account going negative very quickly because they're applying leverage. And it created this big drop in price where people not only they were threatened that their account could blow up. I mean, we saw a 30%, 35% correction, and most people are leveraged 1.5 to 4 times. So if you're leveraged obviously 4 times and the market drops 30%, it's very easy to blow your account up. Even if you're at 1.5 times, you're still looking at a 70 or so or 65% loss on that pullback. So that created forced liquidation. It brought people's sentiment to a high level of fear where they really ejected out of the trades, and it created that complete market collapse. And then to just throw extra fear onto there, we had COVID, which none of us, I mean, you start watching how fast it could spread, and the population, how it's like doubling and doubling, and how quick it goes. I mean, people were afraid for their lives, and I mean, we still are, but back then it was much more of an unknown. So people were not liquidating just stocks. They were actually scared for their lives and liquidating everything. So we saw stocks fall, and then we started to see the safe havens start to collapse. We saw bonds pull back about 15% from their high. Gold fell substantially. Gold miner stocks fell almost 60%. So it was forced liquidation because of fear of losing money, fear of losing life. And then you have these margin calls that even the people who are trying to ignore what was going on, saying, I'm just going to hold my gold and my stocks and silver, well, the margin calls kick in, and whether they looked at their account or not, their brokers started selling off their positions, and that's what created the real collapse near the bottom. That that last 10% was just a margin call washout, and that's what you need. You need to get rid of the leverage in the market or the asset class, so it's fresh and clean, it's cleansed, and now it'll have potentially months or years of people accumulating and then getting over leveraged, and we'll get to another top eventually, that process.
Mm-hmm. Yes, that was way better than I could ever even have tried to paraphrase you on that, Chris. And it makes me think that, it's actually a good thing that happened in March then, because I'm thinking back and it's almost like we had this massive capitulation in December of 2015. Then we had another one in 2017. I remember buying centenarios with no premium over spot because nobody wanted to buy gold. So it seems like we just had this third final flushing, this washout, if I could call it that, of a capitulation there in March. So that sounds good. Now, Chris, I've been so excited about gold and silver this week. So my eyes have not been on the miners at all. So what are you looking at the miners in the charts? How are the miners doing? Are they just as exciting as silver and gold right now, Chris?
They are. I mean, yeah, when you look at them all, I mean, gold broke out last year. It's already had an incredible run. I mean, it's about to threaten all-time highs here. Gold miners, they broke out a couple months ago. They're already having a good run, and they continue to extend. And I love gold miners, and I think you got to have them in your long-term portfolio for certain portions. And they're really exciting because there's big 50-60% gains to be made in just the ETFs like the GDX, GDXJ. I mean, if you get into the much smaller gold miners, the juniors, the micros, I mean, obviously the returns can be absolutely incredible, thousands of percent. So there's a lot of potential with gold and taking off in the miners. And surprisingly, gold is up testing these all-time highs. And gold miners haven't really exploded. Considering they're making more money per ounce than ever before, they're nowhere near their highs. And that's been a big kind of, I think it's caught a lot of people off guard. It's caught me off guard. Naturally, we were thinking, a year ago, gold miners should lead the way. Typically, the equities for a commodity break out first. It's the most speculative asset way to play it. And then the physical commodities follow. But we've had the complete opposite. We saw gold break out. Gold miners are performing. They're in a bull market now, but they're definitely not, up near the highs. And then silver's breaking out. So everything seems almost backwards this time around, which is a little bit of a concern. I think the physical metals is kind of the way to go. And maybe it has to do with, the financial system in general. Like, how much can you actually trust it? What happens if something big happens with the financial system and you don't get your money out of the stocks for the equities or the ETFs or the brokers, or who knows? I mean, I don't trust the financial system, which is why I'm a big fan of physical metals, gold and silver. And you can play the equities as kind of extra icing on the cake juice. But if you're putting huge money to work, I like to keep physical metals out of the system and, safe, privately stored. So
yeah, I would agree. And that's probably why you are so good at making all your calls, because you got that solid foundation first. So you're not quite as, just at a very, very, very crude level, I'm talking here. But it wouldn't be as concerning if, like, for example, me, I prioritize physical gold, physical silver. So if I spend a couple $100 in the markets and I blow up that trading account, well, I still have that foundation there. Yeah. So I don't even know if that made sense or not. But let's move on to equities, because some very interesting things are happening in the stock market. The NASDAQ made an all-time record high, but none of the others have confirmed that all-time record high. And then all of a sudden, we've got this Robin Hood phenomenon that, people like to say, well, it's obvious when you look at how many traders there are moving into this. Well, not traders, the newbies really was what they are. So I guess there's several questions here. Several questions. And let me just go on for another minute here if I can, Chris. Because as a matter of fact, I just saw this article on Fox News this morning, and it was about this Tesla Cybertruck. And this article said, Chris, that this Tesla Cybertruck, you've seen it, right? That little like Terminator-looking truck thing. The
one that nobody's going to want to buy.
Yeah. This article on Fox News said the Tesla truck is going to be all-wheel drive, can pull 14,000 pounds and has a range of 500 miles. There's no way in heck that that's even theoretically possible. I mean, theoretically, yeah, but in the real world, there was no way in the world that those things could happen. A lot of people don't know this, but I drove big trucks for Uncle Sam. So I'm telling you right now, that Tesla truck cannot do that.
Well, maybe they have a 14,000-pound load of batteries they're hauling.
Yes, that's the only way, Chris. That is the only way. So I mean, there's just total market insanity right now. The Nasdaq's taken off. The other markets haven't, the other indices and stuff haven't confirmed it. I know you've been looking, saying this is a dead cat bounce. Yes, it's new all-time highs, but has anything changed your outlook with this all new Robinhood phenomenon? What do you think of that? And are you still looking to retest those lows here, Chris?
Right. So when I look at the broad market for its health, I don't focus on the Nasdaq at all. Yes, that is making new highs, but really there's only a couple little sectors, which is really tech and healthcare and builders are just starting to poke to all-time highs. The thing is, the rest of the market isn't. It's very selective. We are in a trader's market where volatility is extremely high. You got to pick the hot stock or the hot sector, and it's only hot for a week or two here and there, and then it fizzles out. So it's a really tough market. And I focus mostly on the SP 500 because it seems to be the best barometer for timing major market cycle tops and bottoms. And so when you look at it, we're not near the highs. We've got much lower stocks. Fewer stocks are trading above their 200-day moving average. And that's not a good sign. When the markets are making new highs like the NASDAQ, when the SP 500 has got this divergence with stocks above the 200-day moving average, it's a big red flag. I actually posted a really interesting chart last night showing the divergence between stocks trading above their 200-day moving average, which continued to decline in February, while the stock market actually went up. And when that happens, the market's like hanging on a limb. It's ready to just collapse and free fall. And we've got the exact same setup right now. And on top of that, bonds back in February, actually it was more like January, started to break into an uptrend and trend higher with a specific type of bullish pattern. And we just had the same thing happen over the last few weeks with bonds again. It's broken out of a falling pattern. It started an uptrend. It's starting to outperform. And so I'll have to send it to you because the chart really just shows how clear it is. There's fewer stocks supporting the market. Big money is moving into bonds. It's kind of like a stealth move. And I think we're about to see a really sharp decline in equities, just like the February one. I mean, COVID's picking up. Earnings are great for a handful of companies, but most companies on the SP 500 are down like 43% year over year or the past earnings. I mean, it's terrible. So it's going to be really interesting to see how things collapse because the VIX is low. We're back down to the February fear levels. Put call ratio, same level we saw in 2016, which means everyone's buying options. They're buying call options to the upside, not expecting a pullback at all. And when we saw this level on the put call ratio, the stock market traded substantially lower. It did a double dip. It traded sideways for over a year. So we're at those levels here where the market is either going to be in a big sideways range for a year or so, or we're actually going to start potentially a bear market. And this to me is still a big bear market, a dead cat bounce. I mean, if you ignore the NASDAQ, which is just driven by one really core sector, you look at the rest of the markets, they're underperforming. And this is just a big dead cat bounce that's sucking in all the average traders. And they're going to be caught holding the bag if this rolls over, just like it does every bull market top. It sucks everyone in and then spits them out at the bottom. I mean, it's perfect for really messing with your head, the market.
Yes, indeed it is. And I've blown up a trading account myself, so I can attest to that. But
Same
Chris,
here.
let's talk about the dollar. Let's talk about the dollar because I think the bottom is about to fall out of the dollar. But then again, I'm not the technical analyst, but we just took out that spike low just today. So it looks like the dollar index, if we're talking about DXY, it looks like the bottom's about to fall out. So what are you looking at with the dollar index or the dollar in general? And what does that mean for the broader markets, Chris?
Yeah, the one thing I have found, the dollar's in a downtrend. Obviously, tons of stimulus is kind of driving it, pulling it lower. There's devaluation going on there, which is one of the reasons why metals are really popping and taking off. But what I have found is whenever we get into very uncertain global situations, or even just in the US equities market, the US dollar seems to come to life and it tends to rally in a big way. So while I think the dollar is kind of killing itself, all the other currencies are kind of doing the same thing, creating all kinds of stimulus. I'm not sure how it's going to fully affect everything. If everyone's devaluing, do they all kind of stay relatively the same value? I don't really know how that's really going to play out, but it's not good for the dollar what they're doing, that's for sure. And I think the dollar will rally. I think when fear sets in, when the stock market starts to sell off, COVID comes back. I mean, it seems like the world always looks over to the US and they're like, you know what? It's the kind of the asset class and the currency we should go to. It's kind of the biggest, the most liquid, and everyone uses it and understands it. So it tends to be a safe haven during times of uncertainty. So I wouldn't be surprised to, when fear kicks in, we see the dollar rally for a big way, and that's going to pull metals back, which is perfectly kosher. I mean, that's what we want really is the metals to rally like they're doing now, but we need to see them pull back and consolidate because anything that goes straight up typically comes straight back down, at least for half the move. So the more something can take a breather, trade sideways during a bear market, if metals trade sideways for 6, 8, 12 months, that is going to be like really the last launch pad to get in before they go ballistic, later this year or early next year. So everything unfolding seems to be unfolding as it should. It's just, it always just feels different at the time because there's always a different reason for a bull market top or the start of a bear market. And it's always something new, right? But the markets tend to move the same in giant cycles. And if you can just get rid of the mental, all the things pulling at you in the news and the headline to think it's different, if you can get rid of that, it's just price action. And we're seeing rotation through sectors. The hot sectors are the last ones everybody wants, tech and gold miners. But what's in favor now will be out of favor in a little bit, and rinse, repeat. It just happens over and over again.
Mm-hmm. Now, Chris, a lot of people don't know this, but you are also an expert on the energy sector when it comes to stuff like natural gas or crude oil or stuff like that. So let's talk about crude oil for 1 minute here, Chris, because I'm looking at the crude oil chart and we filled that gap on the daily chart. But I'm also looking at, I'm seeing very little movement in price. Sure, you could call it a sideways channel and we've just slowly drifted to the upside, although I'm not the pro, so I'm probably calling it wrong when I describe it like that. But I'm seeing very little movement in the price of crude, give or take to either side of $40. So what should we be looking at with the price of crude? What are you looking at with the price of crude, and anything you would like to talk to about that?
Yeah, I think crude's setting up for a really good trade to the downside. That's where I'm actually looking for something. So you mentioned the price gap. So for those listening, back in February, crude oil closed one day and the next day it opened substantially lower. It left a huge gap on that chart. And gaps tend to get filled, especially in the stock market more so. But those gaps, when they get filled, typically become resistance area. And we've seen crude oil rally all the way up. It's hit that gap fill. It's filled it. And now we're starting to see again this very tight little sideways range. And in the last couple of days, we saw a quick pop in price. And so I've been telling subscribers, listen, we're looking for a little pop and a squeeze, a short squeeze to the upside. I'm hoping we're going to see crude oil. I mean, maybe it's already had its little pop, but I'm hoping we're going to see 44, maybe $45 on it in a quick kind of pop. And then we see it followed by a big reversal to the downside. And that would be a short squeeze, trying to get everyone out of the market because crude looks like a great short trade. It looks like it's ready to collapse. And the fact that it had this little pop over the last 2 days has squeezed those shorts out. People are like, it's starting to run. I got to get out. And that's what we want. And so now we're just waiting for crude to drop a couple bucks, a buck or three from here. And then I think we're going to see it start a new downtrend. And from there, I think there's going to be tremendous downside potential. And I think a lot of things are going to come together that maybe COVID starts to take off more, or we're seeing initial jobless claims. They're actually starting to rise this week, which is what I talked about last week actually on the radio. Say, hey, jobless claims have flatlined. Based on the trajectory, we should be positive actually this week, which we were. So now there's more people becoming jobless again. So we're just starting this upswing. I think a lot of things are coming together where when people see the economy is actually in a slide, crude's going to dump out again, collapse. And a lot of things are. Market's going to roll over. Bonds are going to be kind of one of the only safe havens. During the crash in February, bonds in the US dollar index were the only two seen as the safe havens during the first wave of that. So they're probably going to be the safe havens again going forward.
So, Chris, we've just had a nice, robust discussion here on a lot of the different markets. So, I just wanted to ask you, because we like to catch up with you every few months here, that as we're moving through summer and we're moving into the fall, like what is like probably the main or the couple main things that you're looking at? What is on your radar the most right now out of all of the things we just discussed, Chris?
Yeah, look, stepping back as like a bigger investor of the big market cycles, I still feel like we're in this topping phase of the stock market. A lot of people don't believe that, which is why they're all piling in buying. But when you look at the market internals, the market's going up with fewer and fewer participating stocks. It's getting stretched to the upside. Stimulus is going to be the wild card, and elections. I mean, we're walking into a huge storm. What's going to happen? 1 trillion, 3 trillion in stimulus. Who's going to be president? COVID flaring up when weather gets cooler. There's so many things. I think the key thing here is to be limit position sizing. We've cut our investing portfolio in half, more or less. We've moved into the precious metals sector because they're in a new bull market, and until they show signs of rolling over, we're going to continue to hold those. So I think over the next 6 months, we're in this major phase where we don't know if we're in a full-out new bull market. We don't know if we've started a bear market. I keep calling it no man's land with the general market, excluding NASDAQ. So it's really just kind of sit back and just kind of maybe trim off some positions that are underperforming, because the underperforming stocks are the ones that are going to collapse the biggest when the market rolls over, just because there isn't anyone wanting to own them. And when the sellers step in, it just free falls. The big leaders like technology, sure, they'll pull back pretty sharp, but everyone is still going to be in the mindset for the first few weeks or month that, hey, this is a bargain. I can actually buy it at a price. People will still be in buy the dip mentality. So the big leaders should be the slowest to kind of fall, or they'll have support levels. So it's really tough because there isn't a really clear trade right now, other than if you're in metals, prepare for a pullback here in the next potential week or so, and it could last a little bit. But I mean, right now you just kind of got to play this trend. If you're long, you can stay long until we start to see this market reverse, but it could get really ugly quickly once it starts to roll.
And Chris, you do a lot of articles, and I think I've mentioned this before, but unfortunately we don't even have, the time or the manpower to publish all of them. But my point with that is you offer a lot of free research that you just graciously give out, but you also have a paid service. And if I'm understanding it right, you also have a chat room too. So I might be wrong on that. So I guess my question is, what can people get out of thetechnicaltraders.com?
Right. So we do have a free blog. I think it's labeled on our navigation free research. We give lots of cool analysis on real estate, different asset classes, energies, all that stuff. So you can kind of follow along and get it. All they are is just kind of big picture ideas. We don't fully trade all of them. We don't trade a lot of them. They're just ideas kind of showing the maximum potential that this sector could run or could drop. And so we're just letting you be aware of what to expect if you're in those sectors. But our paid newsletter, which we don't have a chat room, but the paid newsletter is every morning I do a short video and I analyze all the markets you and I just talked about. I cram it into about an 8 or 12-minute video, and I draw on the charts and I explain and I do measured moves. You can see how to do it. Very educational, and you get to see the market every day, just kind of one bar closer as it unfolds. We can predict where silver and all these other assets should hit intraday or over the next couple of days, where they're likely to pull back, and we can watch the markets kind of step their way around the chart. And from there, once we see a trade set up, I send out a trade alert and we trade ETFs, and you can play whichever sector the best asset is kind of at the moment.
There you have it, folks. Check out The Technical Traders every single day, because if you're only getting it from Silver Doctors, you are missing a whole lot. And I do suggest that you subscribe to The Technical Traders, because you'll get even more detailed information than that. Chris, I'd like to thank you for joining us again on Silver Doctors.
Hey, thanks, Paul.